Understanding leveraged buyouts, LBOs. What is a leveraged buyout? A leveraged buyout, LBO, refers to the practice of acquiring a company largely through borrowed funds. In most cases, the debt incurred during such acquisitions is secured against the assets of the acquired company, as well as the assets of the acquiring company. Although leveraged buyouts have fluctuated in their popularity and perception, they remain a pivotal part of corporate finance and investment strategies today. Key characteristics of LBOs. 1. High debt ratio. In an LBO, the ratio of debt to equity used for the acquisition is as high as possible. This maximizes the potential return on investment but also significantly increases risk. The exact amount of debt varies depending on market conditions, investor appetite, and expected cash flow post-acquisition. 2. Use of junk bonds. Often, the bonds used in LBOs are not investment grade and are referred to as junk bonds due to the high leverage involved. The use of such financial instruments is a hallmark of most leveraged buyouts. 3. Targeted companies. Firms commonly target mature companies in established markets that can generate reliable operating cash flow, thus enabling the payment of the debt incurred. Companies in sectors with predictable revenues, such as healthcare, technology, and consumer goods, are often favorable candidates. Why do LBOs happen? Companies engage in leveraged buyouts for several reasons. Taking public companies private. One of the common motives includes to acquire public firms and delist them from stock exchanges, often enabling the acquiring firm to restructure without the scrutiny of public markets. Spin-offs. LBOs may involve the divestiture of a subsidiary or part of a larger company to streamline operations or focus on core competencies. Acquisition of larger firms with limited capital. By leveraging debt, acquirers can purchase companies they may not be able to afford outright, thus expanding their portfolio and market influence. Financial returns in LBOs. Returns for investors in leveraged buyouts can be achieved through 1. Debt repayment. Companies associated with LBOs pay down their debt over time, thereby increasing the equity value. 2. Improving profit margins. After acquisition, investors often implement cost-cutting measures or strategic changes aimed at increasing sales and improving operational efficiency. 3. Resale strategies. The ultimate aim is usually the resale of the company at a higher valuation than the purchase price. This can be achieved within the investment timeframe, typically spanning 5 to 7 years. Historical context and resurgence. Leveraged buyouts gained notoriety in the 1980s and then saw a boom during the late 1990s and early 2000s. However, the 2008 financial crisis led to a significant retreat in LBO activities. By the early 2020s, LBOs witnessed a resurgence, with massive deals being undertaken by major private equity firms. Noteworthy examples include HCA acquisition, 2006. This acquisition was led by Kohlberg Kravis Roberts & Company, Bain & Company, and Merrill Lynch, valued at approximately $33 billion. Medline buyout, 2021. Blackstone Group made headlines with its acquisition of Medline, valued at $34 billion. Citrix Systems Incorporated, 2022. In January 2022, Vista Equity Partners and Elliott Investment Management completed the leveraged buyout of the software manufacturer for about $13 billion. Types of companies attractive for LBOs. Investment firms typically favor mature companies in established industries that exhibit consistent operating cash flow. Companies that generate predictable revenue are preferred because they have a better capacity to repay debt. Established product lines. Businesses with well-established products or services face fewer risks compared to startups. Strong management teams. Leadership that can effectively steer through the acquisition process is crucial for success. Viable exit strategies. Firms need a clear plan for either public offerings or sales to realize gains from their investment. Conclusion. Leveraged buyouts represent a strategy rich in complexity and risk. They allow acquiring companies to obtain larger assets without a large initial capital outlay, ultimately leading to substantial returns if executed correctly. However, the practice garners criticism for the financial burden it can impose on target companies, making the understanding of LBOs essential for investors, corporate professionals, and stakeholders alike. As leveraged loans are projected for a boom in 2024, these financial strategies could play a critical role in shaping corporate landscapes in the coming years.